Are you excited about the possibility of being one of the approximately 40% of American homeowners who own their property completely outright? Can you picture that? It's liberating to go out onto your lawn and notice how different the grass feels because the bank no longer owns your home. But, like other homeowners, you're tethered to a mortgage by a chain of obligations you can do nothing about. You don't have to worry. We'll teach you how to pay off your mortgage more quickly so that you may finally join the ranks of debt-free homeowners. Hey folks, this is Capital Finance. In this video, we will discuss the mortgage secrets that banks don't want you to know. Before we begin, make sure to like this video and drop your thoughts in the comment section below. Let's talk about mortgages first. The 30-year fixed-rate mortgage for $300,000 with a 4% interest rate is an example we'll use to illustrate this point. There are now two parts to a monthly mortgage payment. It consists of the principal and the interest, and the bank uses an amortization schedule to determine exactly how much you must pay each month over a 30-year period in order to pay off the whole debt. As long as this amortization plan continues to provide the same monthly payment, nothing will change. Even if you increase your monthly payments or invest more funds in decreasing the debt, your monthly payment will remain the same. Those two elements will alter monthly. How much goes to the principal and how much goes to interest. This means that the amount of interest you pay each month is directly related to the amount of money you owe. The first month is when you owe the money $300,000. Simple math shows that 4% of $300,000 equals $12,000, which is divided by 12 equals $1,000. So, when you make your first payment, you owe $1,000 in interest to the bank. Because your payment in this case is $1,432, it is the most amount you will ever owe on the account. As a result, $432 will be applied to the principal and $1,000 will be applied to the interest. Afterwards, they repeat the exact computation throughout the entire process. For the second month in a row, you've paid $432. For payment number 2, they will multiply this new outstanding sum by 4% divided by 12, which will be the interest payment. The principal will continue to be reduced as long as the amount above continues to be paid down. Your monthly payment will remain the same, but the amount you pay towards principal will increase each month, and the amount you pay towards interest will decrease each month since you owe less money. For example, if you decide that you don't want to spend 30 years of interest, you may just pay the bank a less amount of interest. One other thing that some people don't realize is that because the interest is accrued monthly, paying your monthly mortgage payment on the 1st of every month as opposed to the 10th of every month or the 15th of every month makes no difference. If you pay your mortgage on the 15th of every month, no additional interest is accrued, so you may do so without affecting your monthly payment. It's precisely the opposite with credit cards and home equity lines of credit, where interest accrues daily on them. Now, let's talk about home equity lines of credit, or HELOC. So, a home equity line of credit is nothing more than a revolving credit line, much like a credit card. You must apply for it and have equity in your house to get authorized since your home is used as collateral. Every day, the interest on the money you borrowed for it is computed. On the other hand, a mortgage is calculated monthly. Suppose you borrow $15,000 from your home equity line of credit. The interest is being added to that money every day. So, they divide their 5% interest rate by the number of days in a year. This means that every single day, they're checking to see how much money you owe on your home equity line of credit, and they're computing the interest on that debt at a time. Then, at the end of the month, they total everything up to arrive at your interest payment for the month. So, now that the interest is computed daily, paying by the due date or a few days before the due date saves you money. Waiting until 10 days after the due date costs you more than paying on time. That's because daily calculations are being made to determine how much interest has accrued. Since the home equity line is revolving, you may borrow $10,000 and then pay it back over time. You may use it as a credit card again as you usually would. It's pretty easy to figure out. In order to pay off your mortgage in 5 to 7 years using Velocity Banking, you need a home equity line of credit. For example, you have a home equity line of credit and you utilize a portion of the funds from that line of credit to pay down your mortgage. For example, if it's $15,000 and you use it to prepay your mortgage, you'll decrease the principal on your loan. Now that you've done this, the interest on your mortgage will be lower because you owe $10,000 less. Even though you're still making the same monthly payment on your mortgage, you now owe $10,000 less on the loan. As a result, a more significant portion of your monthly mortgage payment will be dedicated to the principal. So, you'll be able to pay off your mortgage faster. However, you now owe a total of $15,000 on your home equity line of credit. On the other hand, Velocity Banking allows you to utilize your home equity line of credit as a checking account. Your paycheck goes into the bank account every time you get paid. When you receive your salary, you use it to pay down your line of credit. In order to maintain your home equity line of credit, you must first pay your expenses with it. What matters is that you remain focused on your objective of paying it back down to zero and then repeating the process. So, instead of putting your money in a bank where you'll earn zero interest, you'll put it in a home equity line of credit, where it'll accrue interest every day. The interest you would have had to pay on those days would be waived if you deposited your paycheck into your home equity line of credit and made principal payments toward it each payday. Then, if you run into a problem paying a debt, you may simply write a check from your home equity line of credit. Although it is theoretically possible, you will need to be careful and watch your spending closely if you want to avoid using your home equity line of credit and spending more than you usually would. Using the home equity line of credit can save you money if you're diligent enough to stick to the plan. However, I believe it is overly complicated, complex, and unnecessary. That being said, here are 5 recommendations I have for you if you are determined to pay off your mortgage early. Number 1. Assume you have a 15-year mortgage. While a 30-year mortgage is a good choice, it is preferable to pay it off in 15 years if possible. This, at the very least, provides you with the flexibility to make the payment as if it were a third a year if you don't have the money for 1 month. However, if you have the extra funds and choose to make the additional payments, stick to the 15-year payment schedule and make every effort to pay it off as quickly as possible. Number 2. Make a few extra principal payments at random. So, if you happen to have any spare cash lying around, head to the bank and make a principal payment on your loan with it. If you don't notify them it's a principal payment, they'll put it to your next monthly payment, so be sure to do so. So if you got the cash, go ahead and pay down your mortgage. That's one of the most straightforward approach to getting out of your mortgage sooner. Number 3. Change your loan to a lower interest rate. Rates are the historically low levels right now, so consider whether refinancing makes sense for you. As long as you save enough money on interest to make the investment viable, it's a good idea. Make sure the closing expenses and interest savings outweigh each other before you decide to go through with the purchase. Also, the length of time you want to stay in the house is a significant consideration. So, there's a moment when it's no longer worth investing. If you plan to stay in your house for only 2 or 3 more years, refinancing isn't worth it due to the closing fees. However, if you plan to stay in your home for 10, 15, 20, or 25 years, and you can save a percentage point on your interest rate, you should consider refinancing. Number 4. Pay off your mortgage with the money from your emergency fund. If you had 6 months of savings in an emergency fund with a 3% interest rate, you may take half of it or even 3/4 of it and pay down the principal on your mortgage to reduce your interest rate. Because you owe less on the mortgage, more of your future payments will go towards principal and less towards interest. Get a home equity line of credit to just sit on it. Instead of relying on it as a source of immediate cash, use it as a reserve for unexpected expenses. However, there are certain drawbacks to this option. If you go through a recession, the banks have the power to take away or freeze your home equity line of credit. That actually happened in 2008 until 2009. This is just something to keep in mind. This is a better option than velocity banking, which involves borrowing money and throwing it at the mortgage. Money sitting in your savings account and not earning you anything is known as idle money. You may use the equity in your house to pay down your mortgage, and you can use the Credit Act as an emergency fund. This is a better way to do it. Number 5. Paying twice a month. So, instead of paying 12 monthly payments, you'll make 26 bi-weekly payments equal to 13 total payments. So, by making bi-weekly payments throughout the year, you will receive an additional payment of 1 each year. You'll cut years off the length of your loan if you make 1 payment each year that goes directly to the principal. So, that's an easy method to speed up the process of paying off your mortgage. So when it comes to paying off your mortgage faster, there isn't an easy way to do it. There aren't any simple you-know-what people aren't telling you about. As a result, the best course of action is to increase your monthly mortgage payment. So that's it for this video. I hope you had some takeaways from this discussion. As always, thank you for sticking till the end. Don't forget to subscribe, and till next time.